Number one.
Good afternoon, gentlemen. Andy Marino of Chapel Hill, by way of Boston. You have argued against the use of alternate measures of profitability, such as earnings before interest, tax, depreciation, and amortization, as measures of business performance. At the same time, you have frequently cited the incompleteness of generally accepted accounting in reflecting economic reality for some businesses, implying that there are some necessary and proper adjustments. Beyond what you recently described in the annual report as the folly of omitting depreciation, could you elaborate on your thoughts on other pitfalls of alternative financial presentations? Is EBITDA, in your view, just too often used as a shorthand for cash flow, or is the entire concept of recasting accounting data a suspect exercise? And which revisions might be appropriate, if any, and what might be viewed as red flags? And does it matter to you who is making those adjustments, analysts, investors for their own purposes, or company managements in terms of how that information should be viewed?
Yeah, we regularly told you for some years before the accounting change was made here a year or so ago, we told you you should not count goodwill amortization. It was required under GAAP, and we obviously complied with GAAP, but we told you every year virtually that I can remember, we said this is not really an economic expense. And we ignore it in our own calculations of earnings in terms of what we will pay for businesses. We don't care whether there's a goodwill item or not because it's immaterial to economic reality. So we have been quite willing at Berkshire to tell our own owners to ignore certain things, and if they disagreed with us, they could look at the GAAP figures, but we felt they were getting misled by looking at the amortization of intangibles. That doesn't mean we think all intangibles were good, but we did feel that was an arbitrary and a decision that didn't make any sense at all. And we've felt, obviously, as we've talked about, we've felt that crazy pension assumptions have caused people to record phantom earnings in many cases. So we're willing to tell you when we think there is data that is more important in economic analysis than GAAP figures. We'll talk to you about it. Not thinking of depreciation as an expense, though, strikes us as absolutely crazy. I can think of very few businesses. I can think of a couple, but I think of very few businesses where depreciation is not a real expense. Even at our gas pipelines, I mean, at some point they'll need repairs, but beyond at some point they become obsolete. I mean, there won't be gas there 200 years from now. We know that. So depreciation is real, and it's the worst kind of expense. It's reverse float. You lay out the money before you get revenue, and you are out cash with nothing coming in. And depreciation, any management that doesn't regard depreciation as expense is living in a dream world. But of course, they're encouraged to do that, by investment bankers who talk to them about EBITDA, and then certain people have built fortunes on misleading investors by convincing them that EBITDA was a big deal. And when we see companies that say, we don't pay any taxes, and because we don't have any earnings for tax purposes, and don't count depreciation and all of that, that's coming, in our view, many times that's coming very close to a flim-flam game. I get these people that show me, they want to send me books with EBITDA in it, and I just tell them, I'll look at that figure when you tell me you'll make all the capital expenditures. If I'm going to make the capital expenditures, there's very few businesses where I think I can spend a whole lot less than depreciation year after year and maintain the economic strength of the business. So I think the EBITDA has been a term that has cost a lot of investors a lot of money. You saw it in the telecom field. I mean, the idea that they were spending money so damn fast, they couldn't have it coming in the door fast enough from investors. And then they pretended that depreciation was not a real expense. That's nonsense. I mean, it couldn't be worse. And a generation of investors were sort of brought up to believe in that. We at Berkshire will spend more than our depreciation this year. We spent more than our depreciation last year. We spent more than our depreciation the year before that. Depreciation is a real expense. Just as much as, the expenditure for lights. It's not a non-cash expense. It's a cash expense. You just spend it first. The cash is gone. And it's a delayed recording of cash expense. How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
I knew he'd do it sooner or later, folks.
And the math,
he made it through the morning, but never all day.